week, and this week we're going to be focusing on the U.S. Treasury's yield curve, something we haven't done yet on chart of the week, but I thought it was very interesting to show you the dynamic of the chart of Treasury yields versus what's happening in the stock market. So as you see in front of you is a visual presentation of the yield curve, Treasury yield curve, and you can see the 1 month yields over here on the left-hand side, all the way out to 6 months are ticking well over 5%. In fact, you'd have to go all the way out to 2 years to see anything that would be drop below 5%. 2-year yield is roughly 5.01%. And if you go further out on the in time on the yield curve, 3-year, 5-year, 7-year, and you see the yields drop all the way down towards 4.2% on the 10. The 20-year jumps up to 4.45, and then the 30-year comes back down to about 4.3. So you can see that the yields dropping here in the middle part of the curve, which is the belly of the curve, is where a lot of people are focused in on right now, and they're waiting to see if these yields are going to climb, if inflation continues to be bothersome, or if they decline as the Fed continues to monitor the situation, raising interest rates on the short end of the curve, and perhaps finally, once and for all, snuffing out inflation. I want to show you this chart as well, too. This is called the dynamic yield curve with stockcharts.com, and you can see it's a better graphic representation of the yield curve as well, too. And you can see that it's called the dynamic yield curve because if you put your cursor out over here on the right-hand side on the S&P 500 chart, you can see the movement of the yield curve. And really what's interesting for us right now is what's happening currently right now. We have an inverted curve, which is shows the Fed funds futures, which is on the left-hand side here, much higher than all the other yields over here. But we see more recently that the long end of the curve, which is right over here, the 10 and the 20-year, have really shot up in yield over the past few weeks. And what does that mean? It could mean that the market is trying to price in strong growth, or it means that inflation is still a problem and the market is pricing in higher inflation. So you can see from down over here when we were at the about a year or so ago, a little less than a year or so ago, we were well under 4%. And as we move along the curve here and the time frame of S&P 500, we see that yields have steadily climbed to where we are today in August. So that's the dynamic yield curve here. It's something we don't often use to extrapolate bear or bull markets in the stock market, but still it's always helpful to know where bonds are at and where yields are at. And it's a reflection of what's happening in the economy and eventually what happens into the stock market. Hopefully that's helpful to you. Have a great day, everyone, and I'll see you.